Hi, this is Randy Finney with the right side of the chart, and today is Friday, July 13th, 2018. In this video, I wanted to really dig into the Qs, QQQ, the Nasdaq 100. I want to look at the short-term, meaning the 60-minute charts here, daily charts and long-term chart, the weekly chart, weekly time frame going back about 10 years. I want to do it on QQQ as well as the top components because I'm seeing a lot some, very what I believe to be very significant developments. And yes, they are bearish developments. And yes, those of you who are bullish, there's two takeaways from this. If you're long and bullish, or maybe you're bearish but you don't want to jump the gun because that's, especially if you're not a very active trader. I can short these pullbacks and rips and dips and get in and out long, short all day long because I have the luxury of doing so, being in front of the computer all day. For those of you that don't, and you want to wait for, some very solid, high probability sell signals, I'm going to cover those today. What those are, what those developments that we need to see to say with a very high degree of certainty that we can now position for a short trade more than just these quick pullback trades. And I'm referring to, as we look at the 60-minute chart here of NQ, it's a wash, rinse, repeat thing. I use that term a lot. I don't have everything drawn out on this one, but there's a divergent low. Going back to here, we had a divergent high. Now this divergent high, we had a rising wedge pattern. It broke down, back tested, and we had a kickback rally. It kind of squeezed out a lot of shorts. And just keep in mind, when you see these patterns, a very clean, bearish pattern, these where we had divergences at this point right here, and that was our sell signal, the breakdown, impulsive selling, but we had a kickback rally. And all this serves to do doesn't mean that that short pattern didn't play out. It just means this was a squeeze. Squeezed out a lot of shorts that jumped in here early. Bulls got emboldened because it looked like this wasn't going to play out. But again, nothing is 100% in trading. These chart patterns, these divergences don't play out 100% of the time, but they do play out much more often than not. And in this case, what happened is you had that kickback rally, and because you sucked in some more longs that said, oh, buy the dip, we'll never go down again, shorts, there was a big correction that followed, and you can see very impulsive selling. And that ended in, no surprise, a divergent low, bullish divergence right here on the, higher lows on the PPO and the RSI, these momentum indicators with the lower lows on prices, and then boom, rally. So again, uh, bull trend correction that was identified in advance by negative divergence, bullish divergence, rally, and here we are again. So, the day I stop believing in what I see, I'd rather be wrong, and I'm very willing to be wrong on this trade. If it gets, if the stops are hit, great. I'll just recycle back in as long as this chart pattern remains intact. Now, what I mean by that is, with I always say this, the charts are dynamic and so is my analysis. So let's just say that we continue to work our way up in here. And let's just say we even go higher. I have to redraw this upper trend line. This is really my trend line. This is a trend line, uptrend line that the Qs are following. This is just a divergence line. Yeah, I connected 2 points, but that's not really what I call a trend line, if you will. It's just highlighting these divergences down here. And then what happens sometimes you get a nice clean separation like this. This is clean negative divergence on the 60-minute time frame. And we had it back here. But sometimes you have that initial kick down, thrust down, and then a little kickback rally. And that can happen inside the wedge or on a breakdown and a back test. But as long as those divergences, that next high is still a divergent high, those divergences are intact. So if I need to extend this line and we do this, great, so be it. Even if they stop me out and those divergences are still intact and I can still make a bearish case, I will reshort the Qs at that point in time. So that's there it is, guys. I don't want to beat a dead horse here, but that's what I'm seeing right now. Just like we had a divergent low here, we had a divergent high here. Watch, rinse, repeat. Yes, the primary trend is up, but I can swing trade or actively trade this all day long and make money whether or not again, you got to separate a long-term investor who's buying and holding in the market versus an active trader. Two different things. And again, for the long-term investors, I'm going to get to those levels in a second where I can tell you with, at least in my opinion, the highest degree of confidence, if all these things happen that I'm about to get to on the longer-term charts, that is when we will most likely see a drop measured in well into the double digits in the markets. So that was NQ, the 60-minute chart of NQ, the E-mini futures, which again, I like the futures. I will always chart both, but if you're charting an index like the S&P 500, Nasdaq 100, or they're tracking ETFs, you're looking at just trades that occur from 9:30 Eastern time to 4 o'clock Eastern, and then maybe you can look at after-hour trades in the SPY and QQQ. But these E-minis trade around the clock, and by doing that, you can often make out chart patterns and developments that you don't see elsewhere. And this is a this was a very clean bearish rising wedge, textbook bearish rising wedge pattern confirmed with negative divergences. Again, 60-minute chart. And that played out for, as would be expected, a correction. We had a breakdown, a little kickback rally. It fell shy of the highs, and we had a very sharp correction. Retraced nearly all that previous move up. And that ended in, not a surprise, doesn't always have to end this way, but this is, again, my favorite swing active trading time frame, the 60-minute charts, ended in a divergent low, and that divergent low preceded this rally that we're in, and now we've come full circle. We're right back to having what we had before, a textbook bearish rising wedge pattern. Doesn't mean it's guaranteed to play out, but the odds certainly favor it, and therefore I'm short right now. That's the trend line, very well defined, even better defined trend line than this previous one here. By that I mean you have a lot of reactions, more reactions off it. And again, maybe this thing continues to work its way up, maybe not. My guess is no, but we'll see. And if I need to extend these divergence lines, so be it. Until and unless they're burned through, that tells me that an impending trend change is quite likely. And let's move on to the more significant long-term charts here. Okay, what I want to do in this video, and I talk about this often, I jokingly refer to QQQ as a tech fund with an Amazon kicker. Why? Well, I'll show you why, and I talk about this quite a bit, but here it is. This is straight off Invesco's website. Invesco is the fund company, the ETF company that runs QQQ. And as you can see here, tech, information technology, that's tech. 61% technology. And then almost 23% consumer discretionary. Of that, almost all of that is Amazon. So therefore, again, you have a tech fund with an ETF kicker. You notice down here you don't have financials. You're lacking a lot of other sectors. I don't see a weighting in energy. That's it. So this is not, QQQ is not a diversified index. It is, again, closer to, it mimics XLK, and you throw Amazon in there and that's what you got. But it is where, it's my preferred trading proxy, because tech stocks are more volatile. When they go up, they tend to go up a lot more because you don't have a lot of defensive issues in here like you do in the SPY. You don't have a lot of steady Eddie dividend paying stocks. So there it is. I just wanted to break that down, make that clear. And then what I often talk about as well, my focus is really on what I call the FAAMG stocks, FAAMG, and that's the top 5 holdings in the QQQ right here, which make up collectively 46. I already did the numbers today. I update this from time to time. This is 46.51%. So call it virtually half. And if you add in the next 5 or 4 there, because you have Alphabet, they're 2 share classes really. They count them as separate holdings, and you can see that makes up almost, that's actually the second largest. You're right around there with Amazon when you add those 2 share classes together. But there it is. So rounding out, you bring the next 4, and that's all we'll look at. We'll look at the top 10 holdings, and that is over 50% of the Nasdaq 100. So if you want to know where the Qs are going, all you need to know is where these companies are going, particularly these top 5 companies up here. And let's go ahead and let's do it this way. Let's start out. I often start, and I did begin with the 60-minute charts, just kind of looking at some near-term stuff. But for the sake of this video, let's look at the long-term charts. We're going to start on 10-year weekly charts. And again, I'm only going to go through QQQ and those top 10 holdings and show you what I see and what I need to see to really say there's a high probability that now we're looking at the next double-digit correction in the markets. So this, again, 10-year chart, and to me, it's simple stuff. And as I continue to say, nothing is 100% because sometimes you can have a divergent high that gets burned through. But these are all the divergent highs that I've marked here over the last 10 years. And you can see the subsequent, that's from highs to lows. So when that divergent high was put in, the last high with the negative divergence, there's all the corrections. And you can see not a one of them is less than double digits. So There it is. And some of these, sometimes you get these consecutive, what I call consecutive back-to-back readings. It's really one of the same divergence, but each one you had a correction within, and that's what we had here so far. We zoom in, we had a divergent high, a small divergent high back here that was put in on in mid-March, and that was followed by a 12% drop. And even at the time we dropped there, I laid out a scenario that I could see the possibility Qs could go on to make another new high, and if they did, it would be a divergent high, and that's what we have here. So that's why, despite the Qs going to new highs, nothing, not a single thing has changed in the long-term outlook. It certainly can. I don't think it will, but it's possible. And what we have to do is, if we continue up, because this, the PPO is a momentum indicator, and it is right now pointing up slightly. It's turned back up, and as long as the momentum is upwards, those divergences are only potential, and they can continue. We can climb, 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 and take out these previous highs, and we no longer have negative divergence. That would be, it would really dissipate this bearish case. However, if and when this PPO line, the blue line, crosses down below that white line, that's the signal line, then we get a bearish crossover, and that will have what I call confirmed the divergence. Again, I don't know if anyone else uses that term. I've used it for years. To me, this is only potential negative divergence. Potential because the momentum is upwards. It burned through. So that's that. And until and unless it's burned through, to me, it's just a matter of, do we go, how much higher do we go before the these technicals manifest in the form of correction. And when I look at this, these other corrections were high-level corrections, that brought us back down. A couple of these brought us back down to the trend line, brought us down to the trend line here. This one broke trend. That was early on in the bull market. Then we set up this new trend line, and boom, these little corrections along the way brought us back to the trend line. But finally, after an extended trend, and just take a look at the scope of these trend lines. Just, you can draw cycle lines if you want, but just look how long that one was that broke there. This one was about that long and it broke there. This one's about the same length, maybe a little bit longer. And so what's happened again, during an uptrend, you get these pullbacks to a trend line, boom, 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 and nothing lasts forever. And sooner or later, it breaks. And what usually happens, look towards the end of a trend, like here, you have a lot more hugs. Early on in a strong trend, you kiss the trend line and you run, rally, kiss it and run, kiss it and run. But towards the end, you start hugging it. And that's the nature. That's the nature of a bearish rising wedge, is that prices are starting to compress. There's not as much vigor on the buying anymore. As there is early in an uptrend, and that's exactly what we're seeing here, and that's why we have this wedging type pattern. And you look how many tests we had of that trend line, and you can just make it out underneath there too, that key 40-week moving average, which is the same as a 200-day EMA when you put on a weekly chart, and you can see that does a great job. Look back here, that red line. If you can't see it, I'll turn it up as bright as possible. Does a great job of defining uptrends, and then boom, when it breaks, get out of Dodge. That's what happened. So those are the things in QQQ that when you see a solid weekly close, a red candlestick, a close below that trend line, which also comes in, not by coincidence in my opinion, almost perfectly with the 200-day or 40-week exponential moving average, that will be your first signal that this trend, the trend off the 2015 lows at least, is now or has then come to an end. Okay, moving along, let's go look at the top components now. So here's Apple. Same story as QQQ. Again, this is the reason I'm doing this video. This is not by coincidence. When you have the largest component of QQQ that makes such a heavy weighting, the charts are going to be very similar. And you can see here, again, back early in the bull market. Remember, this is 2009. That's when the market bottomed. And here's the beginning of the bull market. You had at that point a series of 3 consecutive divergent highs. Each one, it may not look like much because I use log scaling, which is imperative on long-term charts like this. Anything with a price range down around $10 up to about $200. If you don't use log scaling, you are going to get a distorted chart picture. So with log scaling, these little pullbacks don't look like much, but that was a 26% drop, 15, 16, and I'm referring to off each divergent high. So 3 consecutive divergent highs, each with their own corrections and in excess of 10%. Next divergent high was right here. That led to a 45% drop. You can see I marked a divergent low. Actually, it shows that not there. It's real. Actually, it was there. It is there. We had a divergent low that led to this rally. And again, we're in a bull market. You don't need big divergences to really trigger or spark a rally. We had a divergent low here as well. But you can see we had a divergent high here, 2 consecutive divergent highs back to back, negative divergence, 34% drop. So a couple things stand out to me. Number one, we haven't had a divergent high or a meaningful correction in Apple since back here in 2016. Well, actually, I'm sorry that we topped back in 2015 and then down to lows in 2016. So you can see this divergence is the longest standing divergence. It's been building now. You can see down here on the weekly PPO and RSI, it's been building since early 2017. And like I like to see, divergence in itself as overbought is not a sell signal. It's just merely an indication that an impending trend change is likely. You can see that looks like we're going to soon have a confirmed crossover on the PPO. We don't have it yet, but what we need to see for your sell signal is a break of this uptrend line. It's pretty well defined. Again, that comes off 2016 lows. So there it is. And that EMA, that 40-week EMA, has just done a stellar job. For years, I've used this on Apple. You can go back and look at some analysis over the years and pointed out how it just does a bang-up job of defining uptrends. So right here, the trend was bullish. The Apple broke below the 40-week moving average again on a weekly closing basis, and it was in a bear market. And it told you it was in a bear market until this point, crossed back above. And then once above, as support does, it acts as support on pullbacks, and then boom, breakdown. And then at this point, you were in a bear market. So there it is. This has defined the bull and bear markets in Apple probably better than any one single indicator or trend line or anything else out there. Is that 40-week moving average, and it's also done a great job on QQQ, not by coincidence, of course. And there it is. So you can see the trend line in Apple, the uptrend line, just like on QQQ, comes right in around the 40-week moving average. So there's what you need to see if you really want evidence that, hey, we're in for more than just a shallow 10, 8, 5, 6, 7, 8% pullback. If we're looking at something more like these double-digit corrections. So there's Apple, Amazon. I'll kind of move a little faster now. No reason to just repeat the same thing. These divergent highs. There it is. We had divergence right there. We had a little at the top there. I didn't have it drawn out. There was your divergent high right there. 32% correction, 14% correction off that one. And there it is. So here's what I'm looking at. We have this primary trend line. Amazon's one of the stronger stocks within the Nasdaq 100. Here's our primary uptrend line. Comes in off the early 2015 lows. And we have this high-level rising wedge pattern. This is a bearish rising wedge confirmed with negative divergence. I have all the confidence in the world that this will break sometime soon, probably in the next, who knows, few weeks, few months, sometime this year. Maybe we have to draw this line higher, maybe not. We'll see. But when that breaks, there's your first sell signal. Look for a weekly close below that line. And then target would be this long-term trend line. I don't think we'll smash right through it. I think we'll come down. We haven't visited that trend line since back here in 2017. So I think that's an ideal and very likely target for Amazon. What I marked here, overbought and divergent high reading. Next up, Alphabet. This is Class A shares, GOOGL. Again, weekly chart, very clean, super well-defined trend line. It just doesn't get much better than that as far as, this goes back to 2011. So there it is. We're still well above trend. So there's no way to knock this stock. It is clearly in an uptrend. It's at new highs. But you can see these divergences have been building. And again, nothing is guaranteed, but I put a very high probability that they will play out. Again, you just don't see a company grow. You don't see a bull market extend this long. And the bigger it gets, the more stretch this gets, the bigger the correction you're looking at when that trend finally breaks and we begin a bear market. Wouldn't surprise me in the least to see this stock, lose half its value. That would be an ideal target right there. Support, I think, would come down to that level, probably all the way down here at about 609. That's a 50% drop. Yeah, it may take a couple years to get there. We'll see. Maybe not. So that's Alphabet. No reason to look at the other share class other than I have, alternative draw. That's really the same trend line, if you will, but I have it here. It's price channel. So again, watch that. You can replicate these trend lines and again use log scaling on your chart. Otherwise, it'll render a different technical picture. There's Microsoft. Same story. Divergent high back here, 21% correction. Divergent high there, 15% correction. There's your divergence lines. And here we are. And these divergences are pretty steep too. There they are. So we just need a reversal, break of this trend line, and that will set Mr. Softy into the a downtrend most likely. Facebook. Facebook's sort of a different looking chart compared to most. We don't have the history that we do on the other ones because it only came public back here in was that 2012. But the only divergent high that I see that stands out clean is this one back here, and that led to a 25% drop right there. And now we have powerful building divergences. But again, these momentum indicators are heading up. So as far as a short and throw away the key, we don't have that yet. We have just these quick trade these pullbacks, go long on the divergent lows or cover on the divergent lows or at support at your price targets until one of these short trades will morph into a runner trade. And any one of them may. I mean, this one that we just did today has the potential most certainly to morph into a runner short trade, meaning multi-month trade, but we'll see. I just don't see it in the charts right now. We don't have enough evidence. Intel, there it is, beautiful looking chart, well-defined uptrend lines. I covered this in detail in the semiconductor sector video yesterday. The semis are very cyclical. You look at Intel in the long term. Here's those, you can see the cyclical nature of these semiconductor stocks in the semiconductor industry, and you can see the corrections are bear markets ranging well into the double digits. So there's not any reason to expect anything less than a double-digit plus drop. And Intel is already underway, in my opinion. This was a very clean uptrend line, bearish rising wedge pattern on the weekly chart. Broke down, impulsive selling, not by coincidence. Look where it reversed, right off that 40-week moving average. It's a key level. You can see how well it's worked here. And you might say, well, Randy, I see a lot of candles that went through there. Well, look closely. That's a red candle. It closed there, but we popped back up the next week and closed right on that line. Here's another one. We hammered, went intra-week below it, and printed a close right on it. We printed a close right on it there, close right on it. So again, don't look for perfection. Don't look for an exact close. Yes, this was a little whipsaw. We traded a few weeks below, but if you go back in time, you can see. And Intel is actually a bad example. Again, I like to use Apple does a better job. This was a sideways, choppy market in Intel in the semis, so it did slice through it. So maybe a bad example at that point, but it's been trending. Again, this is when you want to use exponential moving averages, and I've always said that. Throw them out the door as well as the momentum indicators when something is in a choppy sideways trend. Moving averages don't work. You want to use them in a trending market. This has been a clear uptrend. That's when it's more significant if and when that 40-week goes on Intel. All right, next up is, oh, and by the way, yeah, just to make mention, this to me looks like the initial kickback rally following the breakdown of the wedge. So, whether we have a little more upside or not, at minimum, looking for an ABC move down and maybe even a, 5-wave primary down on Intel after this for you EWers. Cisco, there it is. You can see these well-defined uptrend lines, uptrend line break. Sometimes you get a kickback rally after a breakdown like we did right here. Sometimes you don't. It's like, what is that? Almond Joy Mounds? Sometimes you do, sometimes you don't. Anyways, there it is. Kickback rally, boom. And there wasn't much of a sell-off after this one. But you can see this trend line is pretty well defined. And there's your divergent high, negative divergence. We didn't even have negative divergence. No, we didn't right there. But we do now. And Cisco's already broken trend. And again, Cisco is one of the top components of the Nasdaq 100. Netflix looks like a nice short. I know, in fact, I was going to post it yesterday morning, and I saw somebody else in the trading room already posted their short and bearish on it. What I'd noticed first, I had an alert go off here. I had a trend line on the 60-minute chart, a couple failures, and I'm kind of jumping back now. I'm not doing that on the other ones, but just to a shorter term time frame because this is a nice looking short. Failure here, a lot of failures there. Just couldn't get through that 420 level, broke this 60-minute trend line moving down lower, and that high was also a divergent high, and that's a 60-minute chart. Daily chart, now we're right at trend line support. So it's be prudent to wait to see this for this trend line to go. Very well defined uptrend line. forms a rising wedge pattern, divergent high. We had a rising wedge and a divergent high here, and had a correction after that. See, little divergence, big divergence. Big divergence equals bigger correction. And there it is on the weekly chart. So there's that same wedge I just showed you on the daily. And what do I think will happen? I think when that wedge breaks down, ultimately we'll come back and revisit this primary uptrend line that comes off the 2012 lows, and that's Netflix. Comcast is one of the few I'm bullish and long. I have a position in this on long-term accounts. You mentioned it as a potential long trade idea back here. We had a nice falling wedge, positive divergence, breakdown, back test, and then boom, it's moved higher. So this is stock picking. And that's why when you trade index ETFs, you're shorting or going long the good and the bad. But again, this is, my point being that judge each stock on their own. Here's a stock that I'm bullish on an index, one of the top components on an index that I'm not so bullish on. So there it is, divergent high, corrections. You can see all the good stuff there. So this is pretty significant support here. It's punched through a little bit, but it may stall out here. I should add another line there for those of you in this one. There's another resistance line right about 35. I think it's going to struggle here for a bit. Possible moves up to 37, but I think it's time to probably tighten up stops on this one. And then NVIDIA, NVDA, finally, I think this is where I wanted to stop. NVIDIA is another semiconductor stock, and here's your trend line you need to break. And I was supposed to be on the weekly chart, guys. There it is, big negative divergence. I mean, we haven't seen negative divergence like this in over a decade on this stock, nor have we seen a run like this. This is a phenomenal run. It's extremely overbought, or it's coming off overbought levels. There's that 40-week moving average just below, and so we had a divergent high here, and it continues to diverge as it moves higher. So, big reversal coming, and I see nothing less over the next year or two than a move back down to that 113 level, and that'd be about a 53% drop. So a lot of money to be made on these stocks if you're a flexible trader. And, do you short it now? No. Why? Because it's right above trendline support. Support is support until unless broken. So there's your sell signal right there. Your first sell signal break on a solid red, impulsive break below this line, ideal on a closing basis. 216 is support. If that goes, it's additional evidence that it's headed lower and so forth. And then there's earnings August 9th on Thursday after the market closes. All right, guys, long video, I know. I'm just going to wrap it up. We're still under the 30-minute mark. Let me do this. Let me jump down to the daily time frame and give you a little bit more to kind of hone in, because weekly charts, you need to really wait to see how the week closes. Give you a few more things to look for as early evidence maybe of, that things are starting to deteriorate, things I'm looking for. So I'll just go through again those top components. Here's Apple. Oh, did I do QQQ? Let me do that. If I didn't, I don't think I did on a daily time frame. All right, QQQ on a daily time frame. This is trend line, comes all the way off the 2015 lows. See this orange trend line here? Very well defined, okay? So that's a 2-day period chart. That's 4 years. I'm going back here to a daily chart. One to watch, certainly a level to watch. But before then, I have this uptrend line right here. So this is the uptrend line I'm watching. And here's our first divergent high we had back here on the daily time frame in March. That led to a nice big correction there. That was just the initial shot across the bow. We've continued to diverge. So we have a larger rising wedge building. This is the trend line we need to see break. So there's your first sell signal, a solid impulsive break below that trend line. Sell signal number 2 comes on a break below that primary uptrend line, and that is a more significant sell signal. Now, I don't think we'd go right through there. I think we'd come down. When we break this trend line, I think we'll work our way down here, probably have a reaction on somewhere around this primary uptrend line. And then we have, this is what I call the nail in the coffin, this 152.84-ish, because that's the recent lows back in January. This is where the market had those stick saves and found support so far. And if we get down there, we're also going to take out, you can probably just make out here, this red line, that's the 200-day EMA. That's the same as that 40-week EMA that I was talking about on the weekly chart. So those are your levels. Level 1 is this uptrend line off the April lows. Level 2, the primary long-term trend line off the 2015 lows, and then that, call it 152-ish level there, or those lows from earlier this year. Apple had in what I call an almost island cluster top pattern back here. You had an island cluster of candles right there. We gapped down below it, came back, and actually we were just about where that first candle was. Then we had a gap right here, kicked back, failed at that gap. So let's extend that trend line. That's a pretty important level for Apple. If we fail here, look for a break of this uptrend line, and then look for a break of this 181.71 level. And again, that 200-day moving average, which is right here, Apple has a lot of room. The 200 days down here. I don't know if you can make it out. I have the color turned down on these daily charts to keep them a little more streamlined. Amazon strong as a ox, obviously lately. Everybody's excited about Prime Day, but here's your first divergent high earlier in the year. That was a 16% correction. This is simply an extension. These yellow lines are just a big rising wedge pattern in the daily chart. So what do we need to see? We need to see sell signal number one comes on a daily break and close below this falling wedge pattern. Then you can see we have a support zone here and a target down here. And of course, that would be just like on QQQ. That's a very critical level because that's where Amazon held the line on those two earlier corrections this year. So those are your salient levels to watch right there. Next up is Alphabet and divergent high. Trend line's a little sloppy on this one. Not my favorite. Let's see what we have on this chart here. No, I don't have I'd have to look at the 60-minute charts, give you some letters on Alphabet. I just don't have a very strong opinion on that one right now. Although it does have a divergent high, but let's move on to the next one. There's your divergent high. Microsoft actually, this is a trend line I'm watching. It already broke down. It's back testing now. It's also, here's your divergence right here, your divergence line. I can extend that now. So we still have negative divergence on this most recent high. And we're back testing this trend line, this minor uptrend line. And then your next target and sell signal would be a break below this trend line here. And I have an alternate trend line drawn there. And again, those lows earlier in the year, right around 87-ish or so. Facebook, this is what I'm watching. See this uptrend line? It comes off the April lows. Let that one little intraday spike, that one candle, let it ignore that one, and we have a pretty clean uptrend line, which was broken. Hit support, back testing right now, and we're also back testing this yellow trend line. Look how well it worked as support. This was a well-defined uptrend line all the way to this point. We broke down, back tested right here, and so right now we have a confluence of resistance that Facebook is back testing. If we can power on through there on especially a daily closing basis and put these trend lines in the rearview mirror, well, good for Facebook. If not, and my expectation based on everything, including the 60-minute charts, is for a reversal off this level. Intel, again, I already shared my thoughts on that. Trend indicator is clearly bearish. The PPO is well below the zero line. You have this clean bearish rising wedge breakdown. Looks to me like nothing more than just an oversold kickback rally. It's the first time the RSI hit oversold levels since all the way back here, mid-July, mid-2017. Earnings coming out July 26th, by the way. Remember, check your earnings on everything right now. Check earnings on all your positions or any potential trades that you're looking at taking. Cisco, there's a trend line broke down. Here's a little uptrend line it's flirting with now. Not very well defined. We didn't even really have a third reaction, so let me move that trend line away. You need to see three reactions, in my opinion, to validate a trend line. But there's a uptrend line that's well defined, and we broke down below. Maybe we come on to back test, maybe not. Trend indicators bearish right now, and we also had a divergent high right here, and those divergences are playing out so far. Netflix, I already mentioned, needs to break this trend line, this rising wedge, and then that one's headed lower. And there's Comcast. I already went over all those. Yep, I did. All right, let's wrap it up here, guys. Long video. Hopefully you guys will find this stuff useful. And again, I'll update as time goes on, as if and when we start to see some of those key levels get taken out. I'll make sure to update that. This has been Randy Finney with Right Side of the Chart.